welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman, that's Josh Lipton. Live from our New York City headquarters, we are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting up to speed 1 hour before the closing bell rings on Wall Street.
On Scott Bessent's 333 plan, what I would say is it's laudable. I think it's aspirational. And to the extent that he or President Trump has a formula, particularly to get us to 3% economic growth and a 3% budget deficit, I, for all, of all people, would be quick to welcome that.
If we do not fix these tax cuts, if we do not renew and extend, then we will be facing an economic calamity. And as always, with financial instability, that falls on the middle and working class people.
The global banks are kind of the stars of the banking universe right now in terms of earnings. That big resurgence in all things investment banking, whether it's M&A activity, a little bit in the IPO side. You've got good debt underwriting as well, and trading results were a little bit down from the third quarter, but still strong year over year.
1 hour to go until the market closed. So let's take a look at the major averages here. We got a little bit of selling pressure after yesterday's big gains, but again, seeing this sort of bouncing around in the narrow range kind of activity. The Dow right now down about 27 points here, 0.1%. The S&P 500 just peeking into the green here, and the NASDAQ down 1/3%. So we had economic data this morning. We had retail sales kind of mixed here, coming in a little weaker than estimated, but the control group, which is the thing that goes into GDP, better than estimated. And then you had Fed Governor Christopher Waller saying, maybe we will cut rates this year if inflation keeps going our way.
Waller's comments made headlines, right?
Yeah.
So really saying, listen, talking to the press, saying, officials could cut again in the first half if, he was saying inflation data obviously cooperate. That's a theme. You mentioned economic data and earnings. That parade continues to roll on. You had Bank of America, you had Morgan Stanley. We have an analyst coming up talking more about that, Julie.
We do. And just to look at the bond yields reflecting kind of the Waller commentary here, you saw the bond yields go down kind of after he talked about that, down 6 basis points on the day. So giving more relief to people. And then if you look on over at the sectors within the S&P 500 today on this sort of mixed day, consumer discretionary down, utilities and real estate up. So the sort of interest rate sensitive groups getting some relief from rates moving down. And then you mentioned what's going on in the banks here, just to get a quick look ahead of our deeper dive into it. Now, it's interesting here today, Bank of America trading a little bit lower, Morgan Stanley higher. Of course, you did have these stocks go up yesterday in reaction to their peers. So maybe some of the then positive numbers today being priced in. Morgan Stanley over the 2 days is up by 8%.
Yeah, of course, investors also, by the way, politics was front and center. You had Scott Bessent,
yes.
Trump's nominee to run Treasury, taking questions from senators, talking about lowering government spending, also clearly mapping out his support for tax cuts and tariffs.
Yes, most definitely. Well, let's talk more about that. Scott Bessent, Donald Trump's pick for Treasury Secretary, facing Congress today for his confirmation hearing. Joining us now, Yahoo Finance's Jennifer Schonberger with the highlights of that testimony in that hearing. Jen?
Good afternoon, Julie. Trump's Treasury Secretary nominee Scott Bessent enduring more than 3 hours of questioning before the Senate Finance Committee with mostly supportive Republicans and some fiery Democrats. Bessent stressing the importance of extending and making permanent the 2017 Trump tax cuts and defending tariffs.
This is the single most important economic issue of the day. This is pass-fail, that if we do not fix these tax cuts, if we do not renew and extend, then we will be facing an economic calamity. And as always, with financial instability, that falls on the middle and working class people.
When it comes to tariffs, Bessent noted that Americans should think about tariffs in 3 ways. First, for remedying unfair trade practices. Second, as a revenue raiser for the federal budget. And third, is an alternative tool to sanctions for security. But Democrats hit Bessent hard, arguing tariffs would be inflationary and hit workers and small businesses. Ranking member Ron Wyden.
I believe these tariffs, you can call it whatever you want in terms of trying to gussy it up. They're going to be paid for by our workers and small businesses. And all through the campaign, we heard they weren't, that foreign countries were going to pay it. I think that's baloney. It's going to be paid for by workers and small businesses. So, your response?
Yes, Senator, I would respectfully disagree. And the history of tariffs and tariff theory, optimal tariff theory, does not support what you're saying. Traditionally, we see that the current, if we were to say use a number that has been thrown around in the press of 10%, then traditionally the currency appreciates by 4%. So the 10% is not passed through.
Senator Mark Warner says he's open to supporting Bessent's nomination. He also says he believes that the targets will not be blanketed, but more targeted. If we were to get blanketed tariffs, he thinks that those would be inflationary. And when it comes to China, Bessent said that the playing field is not level and needs to be leveled. He said that if he was confirmed, he would push for purchase guarantees to be enforced and would look for those to be backfilled from over the past 4 years when they haven't done so. He's also looking to make sure that the U.S. remains a leader in AI and technology in the race against China. Now, when asked about the independence of the Federal Reserve and whether the Fed should remain independent, he said that monetary policy should remain independent, but that President-elect Donald Trump will voice his views. He said the president's comments that he wants to have a say in Fed policy were a inaccurate article from the Wall Street Journal. Bessent was also asked about a central bank digital currency and said that he does not favor one. Back to you.
Thank you, Jennifer. For more on Scott Bessent's confirmation hearing, let's now welcome in Kim Wallace, 22V Research Senior Managing Director. Kim, it is good to see you. So let's talk about Scott Bessent before the Senate, Kim. You know, you actually used to work at Treasury, Kim, so interested to get your line of sight here. Start big picture, Kim. You were listening. How did you think he did?
Oh, he did very well. I don't think there's much doubt that Scott Bessent will be the next Treasury Secretary, and my guess is that pardon me, it'll happen either the first week of February or the week before.
And, you know, as you say, he wasn't one of the more controversial picks, right? So what did we learn today in this hearing that we didn't already know? What were you most looking forward to getting sort of more granular on, and what did he deliver on in that way?
Oh, exactly what you all have been talking about. Mm-hmm. There's been a great deal of uncertainty around tariffs policy and what the proposals might be. We still don't have hard proposals, but it's very difficult to step back, listen to Bessent go through the 3 criteria of why you would use tariffs in policy and conclude that they're not going to use tariffs as policy. The president-elect has spoken about raising revenues through tariffs 3 consecutive weeks now. Speaker Johnson has a budget draft that includes 10 years, nearly $3 trillion of revenue from tariffs. You ignore the assumption around the revenue, but the point that it's in a draft to raise revenue tells you that very likely to remedy unfair trade practices, to raise revenue, and to help negotiate, maybe without having to use sanctions, we should expect tariffs from the incoming administration.
And as you look ahead, you know, Kim, do you see those tariffs being as broad, expansive, universal as Trump has sometimes suggested when he was on the campaign trail, or no? Ultimately, do you think they're going to actually be more targeted, more specific?
You know, Josh, I would not get out over my skis or even my rollerblades on guessing what that policy is going to be. There have been a lot of proposals. Stephen Meron and Scott Bessent have written on their preferences around tariff policies. There is a school of scholarship that believes targeted temporary tariffs may come, something Senator Warner alluded to, that could be put in place and might not have much macroeconomic feedback. Across the board, 10, 20% tariffs, it's very difficult to find many people who believe that that won't have some adverse macroeconomic impact. It depends on what they propose. My guess is we'll hear a little bit about it in the inaugural speech and probably week one of President Trump's second term.
And when it comes to Scott Bessent's responsibilities, what do you think is going to be the biggest priority and challenge, perhaps, presuming he does get confirmed?
Julie, there was a lot of discussion, bipartisan discussion, about pro-growth fiscal policy. It's an easy phrase to use. It's really difficult to pin down definitionally, and it's much more difficult to pass as policy. My sense is that Scott Bessent's going to spend a lot of time managing fiscal policy and the communication of motivations and hoped-for outcomes. There's a wide gap between members on Capitol Hill as to what pro-growth might mean. There is some notion that spending cuts can get you there. I don't think the data supports that position. We don't have a spending problem that's not caused by automatic spending. That is, the growth in spending in the U.S. comes from mandatory spending, both entitlements, mainly Medicare and Medicaid, but also net interest payments. The Treasury Secretary designate said that Social Security and Medicare would be out of bounds for cuts. You're going to have a hard time reducing the deficit significantly, much less to 3%, if you are going to exempt entitlements from that calculation.
Kim, separately, kind of a personality question. You know, it's interesting. Bessent did put forward this idea, Kim, of naming a shadow Fed chair as Powell finishes out his term. He then kind of walked back from that. But I'm curious, I mean, given that, if Bessent is confirmed, he would be working very closely with Powell. I would imagine they would get lunch from time to time. I mean, does that create kind of a bumpy relationship? Or no, it's Washington, it's politics, everybody's used to sharp elbows, Kim?
Josh, you know, time will tell. Obviously, Scott has not repeated, at least not in a full-throated manner, the way he did in the Barron's article you referred to 2-3 months ago about a shadow FOMC. In fact, I haven't heard much about it since that was published. They're two smart guys, accomplished people who care about their country. My guess is that the finance minister and the central banker of the U.S. are going to have a working relationship as long as they are each in those seats.
Kim, I'm broadening out a little bit beyond fiscal and monetary policy specifically. Of course, the inauguration is Monday, and there's been a lot of reporting about perhaps expected flurry of executive orders. I'm curious what you're hearing, what you're looking to, and what you think could be, you know, potentially most significant from an economic perspective.
Julie, that's a lot in a short question. No, it's fair because everyone's focused on that rightly. My guess is that there will be executive orders that come. I've heard ranges from a few dozen to a couple of hundred. I'm not going to, you know, I don't know how that's going to work. But I do believe that on issues related to immigration, particularly deportation, I wouldn't be at all surprised if we had executive orders under the International Emergency Economic Powers Act on tariffs day one. Again, not going to guess what type or the magnitude of them. And clearly, the incoming or the president-elect wants to scale back some of the, if not a lot of the energy policies pursued by the current administration. And so I think you might see executive orders on exploration and production on federal lands. President Biden put out of bounds a very large section of offshore water for drilling. I would bet that the incoming president is going to want to change that, and he might try to do that through executive orders. Those are some of the areas that we think are easy to anticipate.
We will be watching for all of them, Kim. Thanks so much. Really appreciate your time.
Thank you.
Well, there's another potential executive order. The future of TikTok in the U.S. hangs in the balance. TikTok awaits what the Supreme Court is going to say on whether it will uphold the ban or sale law, a law that could lead to a ban of the social media giant if it does not divest from its Chinese ownership. And as the deadline looms, President-elect Donald Trump reportedly is looking at stepping in to try to circumvent a potential ban. Let's get to Yahoo Finance's Alexis Keenan with more on whether we're working. And I say try, because there's what's being reported on, there's whether it will work. So tell us, first of all, what we're hearing.
Right. So, well, there's a number of things floating around. One is maybe Biden jumps in and issues some sort of extension here at the last hours. Maybe there's more legislation put on the table that overrides this other statute that Congress has passed. There's Massachusetts Democratic Senator Ed Markey has said he's going to put some legislation on the table. But as far as what we're hearing from sources from a lot of media outlets saying that President-elect Trump is looking at an executive order. And what would that look like? Well, there's some really, really great Supreme Court precedent, well established on that exact matter. And it comes from a case, it's a Youngstown case, it's a Steele case from 1952 during the Korean War. And what it says is that, and at this time, President Truman then tried to have the U.S. Secretary of Commerce take over the U.S. steel mills to avoid labor strikes, to keep the production going. And what the Supreme Court said at that time was, no, that's not possible. The president does not have this authority. So the test goes like this. Either Trump would have to show that the law itself is unconstitutional. So if the Supreme Court says it's unconstitutional, well, they're looking at First Amendment grounds. Trump could come in and say, well, there's some other grounds to why this law is unconstitutional other than the First Amendment, if the court does uphold it on the First Amendment grounds. Otherwise, Trump could go in and say, well, he has separate executive authority in order to do something above, adjacent to, beyond this law. And that's going to be really hard to do, legal experts say. The Supreme Court's really reluctant to try to put that kind of power in the hands of the president, because if it's not by statute, if the law is said to be constitution, then the Supreme Court starts to be concerned that it's sort of like king-like power, which we don't like very much here in the United States.
So we're waiting for the court. What happens if the court steps in, Supreme Court steps in and says, we're not going to uphold the TikTok ban or sell law?
In that case, TikTok can go on its merry way. The 170 million American users can keep using it. Doesn't mean it won't be open to some other challenge in the future, or it won't be open to some other legislation in the future where Congress goes back to the table, because the court could strike it down totally, or it could do it in part. It could say, well, as to the government, it doesn't violate the First Amendment, or as to the TikTok users, it doesn't violate the First Amendment, right? So the court could split this case and decide that the First Amendment protections are different for both of those parties. So a lot yet to be seen here, but an executive order is not necessarily a really sure, or even just a very, let's call it a narrow path to trying to get what Trump wants to be done here and get some more time for TikTok. But look, the government told the Supreme Court that no matter what happens, even if the ban does go into effect, they said, look, nothing's irrevocable here. Even if a ban starts to happen, doesn't mean TikTok can't come back to the negotiating table and try to work something out with the government.
And meantime, the CEO of TikTok reportedly will be up there on the stage with President-elect Trump on Monday. So interesting confluence of events. Thank you so much, Alexis.
Yeah.
Well, stocks are lower on the day as we're counting down to the closing bell on Wall Street. Stick around, we got much more market domination still to come. Welcome back to Market Domination. Stocks wavering today, struggling to build on Wednesday's surge. While investors are expecting another banner year, our next guest thinks a stronger than expected economy in the first half could force the Fed to potentially raise rates in the second part of the year. For more, we want to welcome in Rich Bernstein, the CEO of Richard Bernstein Advisors. Rich, lay this out for us, because this is something that some strategists and investors have been floating as a possibility. What would lead the Fed to have to raise rates this year?
So I think we have to start with the realization that we're entering 2025 with an economy that's actually quite healthy, right? I realize we've just gone through a political season and the consensus has been the economy stinks, but that's not reality. The leading indicators of the economy troughed, I don't know, 5-6 months ago. Leading indicators of employment have been very strong. You saw that in real time on Friday with the employment report, which I don't know why that was a surprise to economists, because I said the leading indicators of employment have been turning up. And despite that strength, we have a Federal Reserve that seems to want to continue to cut rates, which is very odd given that we've got a reasonably healthy economy. We've got a very healthy labor market. We have the possibility of tariffs, which we've been discussing before. All these different issues are going on, really argues that nominal GDP and nominal corporate profits, the key word there is nominal, meaning real growth plus inflation, nominal growth is likely to be stronger than people think. Well, that may force the Fed's hand where they either have to explicitly go on hold or maybe even raise rates.
And when you're talking to clients, Rich, raising rates, I mean, is that your base case, or what are the kind of probabilities you would put on that?
So I would say I don't have a numerical probability. I know everybody likes things like that. I don't have a numerical probability, but I think it's something that people aren't considering enough, right? That everybody wants this great scenario where we have growth and no inflation because productivity is wonderful. Well, that's not really the story of the United States. That doesn't happen as often as people would like to believe. So I think given that we're probably going to see stimulative fiscal policy, we've got the Fed who wants to cut rates, we've got an existing healthy economy, we've got tariffs, we've got all this, that it's likely that the Fed will go on hold. That I think we should assume, with some possibility as the year goes on that maybe they have to start raising rates. I think it's a real possibility.
Anytime the market gets a new piece of information that even leads it to believe that the Fed is done for now, you know, there's kind of there's some disquiet, to say the least, right? So if indeed there was a scenario that the Fed would be raising rates, I mean, that doesn't seem to be priced in at all, right? How much consternation would that cause?
Yeah, so here's the important point. I think that despite all the stories of fundamentals and people watching fundamentals, the reality is the last year to year and a half has very much been a liquidity-driven market. If you look at things like cryptocurrencies, very high correlation to financial conditions. Even if you look at the Mag 7, the stocks of the Mag 7 have a very high correlation to financial conditions. We've had very easy financial conditions to start with, and the Fed was cutting rates into that. So, you know, that's why we got some of the more speculative elements of the markets performing the way they did. That may come to a loggerhead in 2025 as this liquidity-driven rally is forced to subside because the Fed starts mopping up liquidity. That argues for more volatility.
So given that backdrop you're kind of laying out there, Rich, how do investors listening right now, how do they want to be positioned?
Right. So we've kind of said Act 1, Act 2. I don't like to use first half, second half of the year because that implies like June 30th at 4 o'clock in the afternoon, everything changes. So let's do Act 1, Act 2. Act 1, I think the economy is stronger than people think. That argues for a cyclical tilt to a portfolio, right? In our portfolios, you'll see we're overweight energy, we're overweight industrials, we're overweight mid and small, we're overweight value, we're even overweight emerging markets ex-China. In fixed income, that would argue you want to be shorter duration than your benchmark, right? Because if you think there's going to be stronger nominal growth, that would argue there's more upward pressure on long-term interest rates. And some of that we've seen, of course. Then if the Fed has to reverse course, Act 2 becomes a more defensive portfolio. Now, obviously, we don't know exactly what that's going to look like because you don't know what the contours are going to be in Act 2. But the textbook would say That would be the time to look at things like staples, healthcare, utilities, quality. Those would be the characteristics in your portfolio. So my guess is Act 1 portfolio is going to look very different than an Act 2 portfolio.
And when do we figure out what the second half portfolio should look like?
Well, I think we'll get there. I think we will start to see. Probably my guess is leading indicators will continue to accelerate. And as that happens, you will start to see interest rates go up. And as that happens, I think we'll eventually begin to choke off the liquidity trade and maybe even choke off the economy, although I doubt that.
Rich, thanks so much. Appreciate your time.
Great to see you.
Now time for some of today's trending tickers, sponsored by Tasty Trade. You can scan the QR code below to check out the best, worst, and most viewed stocks of the session on Yahoo Finance's trending tickers page. So let's take a look first at shares of Apple. The company down by nearly 4%. There is a report that it has lost its top spot in China, falling to third place in the smartphone market. That's according to data from research firm Canalys that was cited by Barron's here. And so, is this the reason that the stock is down? Maybe it was a contributing factor, but we are definitely seeing more volatility that has crept back into the market today.
Yeah, per their research, Apple does lose its #1 spot in China. Says iPhone shipments in China fell 17% in 2024 to just under 43 million. So that means Apple third place over there behind Vivo and Huawei. One important point to point out, Apple's new selling point here is the AI offering, Apple Intelligence, that is not available in China. You do have intense local competition. But again, to your point, Julie, this is third-party research, right? So we don't have official word from Apple. You're going to get that January 30th. That is when they're scheduled to report their Q1 financial results. They are, and it was interesting. I was looking at the stock action, too. We were just showing that one-year chart. The stock actually closed at a record high the day after Christmas, Boxing Day, 12/26. And since then, it is down by more than 10%. So technically has entered sort of a correction here with that pullback. When I checked earlier today, the pullback was about 12%, in fact. But the stock is down a little bit more since then. So that number would be a little higher. All right. Let's move on. Let's take a look at Symbotic here. Those shares surging as the company inks a deal to buy Walmart's robotics business. We're up about almost 20% in today's trade. So this is the warehouse automation company agrees to acquire the advanced systems and robotics business from Walmart, which also, I guess, chooses Symbotic to develop an advanced solution, Julie, that automates its accelerated pickup and delivery centers. Bottom line, Walmart's going to pay the company a total of $520 million. Deal closes in Symbotic's fiscal Q2 25. Right. So they buy the business, but they keep doing the business with Walmart. So sort of, I guess you could say a win-win for the robotics company. I was looking at the history of this one. This one was a de-SPAC back in 2021. So $10. That's the reference price, I believe, for all of these guys. And now it's trading at 32. Although they did do another offering higher than that. So in other words, it's seen a little bit of volatility. But I've been thinking a little bit about these stocks from 2021 when we had that huge IPO and SPAC wave. And then many of them had a really rough couple of years. Symbotic is one of those that then has come back up to some extent from those lows where it was in those years. And our next mover falls into that category as well. Let's talk about it. Okay, we're talking Duolingo. That company says that it is seeing 216% growth in U.S. users learning Chinese compared to this time last year. They said this in a tweet. They said Mandarin learners in particular, and they said in the tweet, learning Mandarin out of spite. You're not alone. They say this, it's the implication that this has to do with what's going on with TikTok and a number of users that are migrating to what some are calling Red Note in English or Little Red Book. I've seen it translated as well, that they want to connect with other Chinese users on that, Chinese-speaking users on that. Yeah, Little Red Book, referring, by the way, of course, to the communist dictator Mao Zedong's manifesto, just food for thought there as you move to that app. But this is, course, as you point out, ahead of the TikTok ban. Apparently, millions now of TikTok users have made that move, and the default language there, of course, is Mandarin Chinese, hence... Right. Well, not even the default language apparently for the Chinese people on the platform, but like the directions, the settings, etc., the notifications.
are in Mandarin.
Yeah.
So if you're an American user who doesn't speak Mandarin, it's a little bit tricky.
Fast.
But to the point I was making earlier, Duolingo had its IPO. It was not a SPAC. It had an IPO back in July of 2021 at $102. The stock's up 65% over this past year.
Wow.
So, and it's about tripled from that $102.
Nice move.
Yeah.
All right, let's switch gears here. U.S. retail sales growing at a slower pace on a month-over-month basis than Wall Street expected. Sales rising 0.4% in December, while economists were expecting 0.6% growth. For more on all that latest economic data, let's bring in now Jose Torres, senior economist at Interactive Brokers. Jose, great to see you, as always. Let's start with that economic data point today, Jose. So we did get December retail sales. What's important there, Jose, is the control group, though, did beat estimates, and that would seem to signal strong growth to end the year there, Jose. But give us your take. As an economist, what did you make of that economic data point?
Happy New Year, Josh and Julie. Great to see you. Well, retail sales have grown for 4 consecutive months. Earlier in the year, consumer spending was a little more volatile. I was talking about light switch spending. Consumers were managing pressures by spending a lot one month only to retreat the next. But we've seen from the 4 months ending in December that we've had strong growth, trending higher. Like you said, control group robust, coming in stronger than expected. The control group essentially removes some of those more volatile elements like cars, fuel, building materials, et cetera, and is more of a direct link to GDP. As far as claims that we saw at the same time, 8:30 a.m., providing evidence of stable labor market conditions. And that has helped consumer spending thrive. Also, the election uncertainty overhang is now behind us. So folks feel a little better about, at least they know sort of what's going to happen in the next few months in terms of the GOP's plans, et cetera.
And Jose, I know you also wrote about the CPI data that we got this week. And the market broadly viewed it as fantastic news, right? That they viewed it that CPI was not re-accelerating to an unexpected degree. But I know that you were sort of looking under the hood at some of the numbers and saying, not so fast. How did you read those CPI numbers?
Sure, Julie. So you had the headline accelerate from 2.7 to 2.9% on a year annualized basis. And on a monthly basis, you had the headline accelerate to 0.4%. But a lot of that was due to energy, both crude oil, gasoline, as well as natural gas, which goes into electricity and heating, right? So those are some of the more volatile elements. But shelter has decelerated for the 3rd consecutive month. And of course, that is a huge aspect of the CPI. So, to the extent that shelter costs continue decelerating, that's excellent news. However, what's the uncertainty? The uncertainty is the Trump administration has an adversarial trade posture. So that can really threaten goods reinflation. Goods really drove the disinflation train from 2022. And we saw those high numbers in the 8s and 9s down to the 2-handle that we see today. So that if goods start to reinflate, we have some significant issues. Also on the labor front, there's some immigration risk. There's talk about folks possibly, going back where they're from, or also some mass deportations, right? There's risk on that driving up wage costs and boosting services inflation, which really hasn't cooperated throughout. We know the labor intensive services have been quite hot, and shelter is decelerating, but it's still running at a pretty strong clip. Tomorrow we'll get some information on building permits and housing starts. Today's home builder sentiment showed an improvement. The real estate sector is showing a little bit of improvement, and part of that reason is loftier growth projections. That's also lifting up the long end of the yield curve. I think we're going to see the 10-year move higher as well as the 20-year and the 30-year.
Jose, given the inflation data, the retail sales data, how is the American consumer holding up right now, Jose? What's your line of sight there? I mean, is it still that same story we've been talking about? Is it the bifurcated consumer, high end holding in there, low end facing some challenges?
Low and mid end facing some challenges, but they have that labor strength. They have that confidence that they will have a job, so that's allowing them to continue spending. The high end, we know the story there. The wealth effect has been really strong in the last few years. Richard Bernstein was talking about it earlier, right? You have these really high stock prices, elevated home prices. That's really driven the wealth effect spending. And that's really why we're seeing this morning's retail sales report reflected broad-based progress. 10 out of the 13 major categories reflected gains. However, I did see that dining out did see some weakness month over month. So I'm really watching that closely, Julie and Josh, because that's a really important discretionary area that filters into leisure and hospitality employment, which we've also been seeing begin to decelerate. We remember leisure and hospitality was one of those sectors of the cyclical sectors that was really outperforming. It has begun to slow down. As far as the rate outlook, our IBKR forecast traders, they've been after seeing the cooler PPI and the cooler core CPI, they've been front loading a Fed rate cut to sometime this summer. Previously, they were of the view that maybe we'll get one in December or maybe we won't get one at all.
Jose, it was really interesting. We were having a conversation earlier with Kim Wallace of 22V Research about the incoming administration. And one of the things he talked about was that there isn't sort of broad economic agreement on what pro-growth means. It's sort of this catch-all term. And I wonder what you expect will be actually pro-growth from this incoming administration, how that's going to affect the backdrop that we've been talking about.
Sure, Julie. So let's talk about incoming Treasury Secretary Bessent, right? He's talking about fiscal responsibility, really tightening up the budget. But President Trump, I don't think, is going to favor those austerity measures. This country, we're not used to austerity. We've been running deficits for a long time, right? The sovereign debt is extremely high. Issuance is lofty. So I think that there's going to be some confrontation between the Treasury and the president, as well as the Fed. So what does pro-growth mean, Julie? Pro-growth means deficit spending, lighter taxation, milder regulatory regime, onshoring, manufacturing push, right? Those are the factors that are going to deliver growth. But at the long end, we're still going to have that interest rate pressure. So to the extent manufacturing can push transactions, that's going to be a little problematic with elevated borrowing costs, and also the real estate sector. It's hard to see light at the end of the tunnel there. So overall, that's really what the pro-growth agenda is going to be about.
At the same time, Jose, so yeah, these pro-growth policies, but you heard Scott Bessent today before the Senate defending tariffs, Jose, right? Defending sweeping tariffs. He's a believer. Trump is, Lutnick is. How, as an economist, are you thinking through that and its potential ripple effects impact on the economy going forward?
I mean, look, it's a risky tactic, right? But President Trump, we saw during 1.0, is not necessarily going to take the path of least resistance every time. He wants to make drastic changes at times, sometimes most of the time, and tariffs are a negotiating tool, right? The Chinese have been engaging in unfair practices, Julie and Josh, for a long time. So are we going to have free trade all around the world, and then we're going to have a few big players play by their own rules, right? Part of that is why we've lost share of manufacturing globally since our peak in 1960s, 1970s, right? So if we're going to have free trade, we need everyone to play by the same rules. So I do think that tariffs as a negotiating tactic could help to broaden out the growth in America, right? Bring some of those specialized manufacturing jobs back to the middle of the country, back to some of those Rust Belt areas, right? And boost a more diverse kind of growth, and not just have an economy that's really dependent on services. Maybe we get some more stronger goods production, especially as it relates to artificial intelligence. We know artificial intelligence has driven much of the stock rally 2024 and 2023. It's a huge trend that has a potential to really change the world. We want to make sure that here in America, we're in more control of that. We don't want our adversaries to take the upper hand.
Jose, always good to see you. Always good to have you on the show. Thank you, sir.
Thank you very much, Josh. Julie, see you next time.
Stick around. Much more market domination still to come. Welcome back to Yahoo Finance. Time now for some calls of the day. B of A Securities upgrading LVMH from neutral to buy, the firm adding the stock to its Europe One list of top ideas. So this was actually a big piece of research, Julie. They kind of look at the whole sector as well. And they see some puts and takes there. They say, listen, 2025, many ups and downs for the luxury sector, Julie. The worst of the revenue decline is behind us. They say, but demand remains muted. At the same time, they tell their clients margins are being protected thanks to lower cost growth and FX. Sector trades to its mid-cycle multiple. So they say, we think it's best to have barbell approach to recommendations, one they do like LVMH.
Right, they like Richemont and Zegna as well. Those are the three companies that they like on the positive side of the barbell, I guess, here. And the company talks a little bit, or the analysts, I should say, talk a little bit about China. They do say that a prolonged China recovery would be a risk here. And they say that if it does take too long, that would be a problem. They do say they see Chinese luxury spending flat in 2025, but that the U.S. could help make up some of that
Americans
will be about 50% or more than 50% of revenue growth this year.
Yeah, they say we think that once there's more clarity around building blocks of demand for the next 12 to 18 months in luxury, LVMH should benefit from its reputation as an industry leader.
Yes. Let's turn to another call now. Truist downgrading Enphase Energy from buy to hold. The note revising revenue and EBITDA estimates for the company for 2025. They talk about that there's a conservative guide for European volumes from the company, and so that fourth quarter numbers will come in at the midpoint of the range here. And they also are looking at a challenging market backdrop here for the company. So all of this contributing to the downgrade that we're seeing.
Yeah, they have some nice things to say. On one hand, they say, listen, they've maintained leading gross margins. They're continuing to innovate. They're staying ahead of the curve. But they say, here's the other side of that. Then they bring down the hammer. They say the combination of a continuing drag on volumes from a weak European market. They talk about intensifying competition in the U.S. Bottom line, 2025 growth below current street estimates is what they're looking for. This stock is a mess, by the way. I mean, it's down about 40% over the past 12 months.
Yeah. Well, big banks entering the Trump era on a high note. Bank of America and Morgan Stanley, the latest of the major U.S. banks to report quarterly results, posting fourth quarter profits that more than doubled. While the collective full-year net income of the six major banks saw a 19% rise in 2024. Here with more, Ken Leon, CFRA Director of Global Fundamental Research. Ken, when you look at the banks here, is this as good as it gets, or are we looking at an outlook, particularly a regulatory environment, that could propel them even further?
Yeah, so this is just the beginning. You know, our view, really, even going back to November, is stay the course. What we're going to see this year is an opening up of markets. We're going to see the consensus revise their earnings upward, not once, but several times, mostly because of the increased volume across multiple businesses. Very positive for the capital markets after the six global U.S. banks reported. We also saw very good activity with elevated equity market. Client balances and fees off of that were also very high, as noted from Morgan Stanley and Bank of America.
Ken, net interest income, generally speaking, Ken, what are you seeing now and ahead?
Net interest income, it was very bearish from the street back in September, October, but with a U.S. economy growing 2.5%, there's two sides of what gets you to net interest income. One is rates, which maybe we'll say stays or goes one cut, but the volumes off of a U.S. economy growing 2.5% is very positive. So I think net interest income, more of a factor for the traditional banks. You know, it's about 55-60% of total revenue. But for Morgan Stanley or Goldman Sachs, 15% of total revenue, really not a factor.
So let's talk about the more traditional banks and that side of the ledger there, because if, as you say, the economy is expanding, if their margins are getting crimped at all because of the net interest margin, would they need then to see a pickup in loan demand? I know, for example, Jamie Dimon was talking about that there had been sort of a lack of loan demand. Do you expect the pickup to come?
Yeah, so my point, again, was volumes is driven by the U.S. economy, loan volume, other transaction, treasury service volumes. Rates, if you get into the bowels of NII, net interest spreads, and even year over year, it's been really not that much in terms of rates coming down. I'm not too worried really about net interest income, but if you're looking at, I don't cover traditional banks. I cover the 6 greatest U.S. global banks. They're diversified, and they represent a significant part of the top 10 constituents of being overweighted in the financial sector, which is where CFRA is. You want to go downstreams to smaller regional banks, could be a bigger issue if you only have 1% growth on commercial or consumer loan growth.
Ken, Trump is back. What does that mean for your coverage universe? What does that mean for the banks you cover in terms of regulatory backdrop, capital requirements?
Well, we have new actors in important roles, not only at the Fed, but across all of the organizations, whether it's the FDIC, the Department of Justice, the FTC. This will open up markets, particularly for financial sponsors, private equity, which has $1 trillion they have to monetize, possibly IPO or M&A. Additionally, what we're going to see is more of a pro-business, pro-economy environment. We haven't had that for 4 years.
And, I guess sort of the Basel endgame and the Basel requirements are sort of a dead. It seems like the banks won that argument, maybe even before Trump came into office.
Yeah, so there's the annual capital stress tests. We also have the Basel III endgame, where the hysteria of 18 months ago was a capital build, increasing your capital for overcapitalized banks that I cover by 20%. Maybe it's 5 to 7%. It's kind of murky, but I think that's really something in the rear mirror, not a risk for investors.
Ken, good to see you. Thank you so much.
Thank you.
Stick around. We got much more market domination still to come.
Tesla is offering discounts on new Cybertrucks, the latest indication that EV demand continues to struggle. For more, we are now bringing in Yahoo Finance senior autos reporter, Pras Subramanian. Pras.
Yeah, Josh, so the Cybertruck, the latest sort of news here is that they're offering discounts on some of the trucks that are in inventory, so new trucks and also trucks that are demos or have like 1,000 miles or so. Various discounts based on the trim level from $1,600 to $2,600 in terms of discounts. Nothing crazy here, but it's just the latest indication that Cybertruck demand is slowing. We saw earlier that they were furloughing some workers at the plant in Giga Austin because of the fact that supply was building up. We saw them introduce leasing for the truck. We also saw them Sorry, I also saw them do these price cuts before. So that's sort of what's happening here, is that what is happening in the Cybertruck. And they sold about 40,000 trucks in 2024, which makes it the highest selling EV pickup. The question is, are those sales slowing down?
Well, and it's interesting because from financial analyst point of view, this was never going to be like a huge moneymaker for them, right? I mean, it wasn't.
How important? How important is it to the bottom line?
I mean, Musk had said that the Giga Austin would put out about 250,000 vehicles a year, up to even 500,000 if needed. So it was considered something of a volume seller for them. That there was indication that they thought this would be a truck that a lot of people would buy, not just for recreational use, but also for work truck use. And that seems to not be the case. Yeah, I mean, it's a pickup truck, right?
Is it a pickup truck?
So I think
can you put stuff in the back?
You
like,
can.
Is it open? Is it open in the back?
Yeah. It has this retractable tonneau cover.
Oh, okay.
But yeah, I mean, so basically the use cases maybe they're more limited to the fanatics, the Tesla fanatics who want this kind of crazy looking, space looking.
That was the thing, because it's a whole new aesthetic, right? It's a whole new look. I mean, it's got this sort of very unique angular style to it.
Yeah, and I think maybe that Tesla themselves are thinking this may have been a design mistake. And you saw the Cybercab the Robotaxi has Cybertruck sort of looks, but it's a bit more accessible, but smoother body panels. It's not as angular and as polarizing as the Cybertruck looks. So I think what's happening here is that the demand story just isn't happening for Cybertruck as of right now. Maybe all the first movers have already bought the truck, and now added incentives are needed to move more of these vehicles, and that's what's happening here potentially with these inventory discounts.
You ever ridden in a Cybertruck?
I haven't, but I want to get Rick Newman and I in one of them, and I think we want to test drive it and then park it outside here and see what people think of it.
Try and tow something with it.
Yeah.
Right? I mean, listen, if you're trying to market the thing to traditional pickup truck drivers who are using it as a working vehicle, it's got to have the power.
Maybe that's the test, is actually using it as a work truck, not just driving it around. Okay.
Yeah, Rick and
tow. You guys go to the farm somewhere.
We'll move some soil. We'll go up to the Yonkers Bureau. Yeah.
Rick and tow his iPad. I mean, who knows? We'll see what happens. Thank you, Pras. While we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and now it is Market Domination Overtime, sponsored by Tasty Trade. We're joined by Jared Blickery to get you up to speed on the action from today's session. Let's start with the major averages here and what we're seeing on the session, because when we checked an hour ago, the Dow was up. Well, just kidding. Now it's down about 68 points. We talked about the volatility we're seeing in that narrow range today. So finishing down almost 0.2%. The S&P 500, similar move here, a little bit of a leg lower at the end of the session. The Nasdaq more deeply in the red, down 0.9%. Now, as we've been talking about in terms of what's driving trading today, the banks not necessarily delivering from a stock reaction-wise the same way they did yesterday. We had retail sales that rose a little bit less than estimated, although the control group number beat estimates. You had Fed Governor Christopher Waller saying, oh yeah, we could get some interest rate cuts later in the year if inflation does cooperate. So a lot of sort of cross currents going on. And of course, investors also watching Scott Bessent's testimony at the hearing to decide whether people are going to confirm him for Treasury Secretary. So all of that feeding into stocks day. A couple things I did notice is that all three majors in the red, but the equal weight, S&P equal weight, higher by 0.8, and the Russell up 1/3%. So that's a divergence that we haven't really seen very much lately, Jared. That is the majors in the red and that other stuff in the green.
Yes, that is true. And sometimes the Russell 2000, the small caps, trade alongside the equal weight more than they do some of the other indices that we look at. I have been focused on the 10-year T-note yield. That is down another 5 basis points today. I'll just show you the 2-year real quick, 2-day, view of this. And it's dropped something like 18, 20 basis points. It's the most since August of last year. And that was Yen-mageddon for all you bond market aficionados. And it's very striking because this is all happening after yesterday's CPI announcement, which came in lower than expected on core inflation. And I think this has set the stage for a rally in treasuries and a decline in yields because they move opposite each other, which will provide a tailwind to stocks through the inauguration, possibly a bit longer. And inauguration's only Monday. That's 2 days away. So we're right there. Here's the 1 year on the 10-year T-note yield, and we have come down off of those highs pretty substantially over the last 2 days, although on that chart right there, it doesn't look like much. Now, here is the sector action, and given the fact that we've had this big drop in yields, not surprising to see utilities, that is the #1 gamer, interest rate sensitive, that is up 2.5%, followed by real estate, that's up 2.25%. And then we got some nice action in the cyclicals, that's on the declining dollar, which is moving in lockstep with yields. So because of that, we got industrials, materials, staples, energy, financials, healthcare. They're not all cyclicals in there, but industrials are. Tech, the biggest laggard today, and in fact, all three of the laggards were those Mag 7 sectors. Josh.
Thank you, Jared. Mixed moves for markets with the Nasdaq underperforming the Dow and S&P 500, but our next guest says the momentum trade may be back. Joining us now is Brian Jacobson, Annex Wealth Management Chief Economist and Strategist. Brian, it's good to see you. So Trump, he's back. The inauguration is here, Brian. You asked the following question. You say, will the first 100 hours be a sell the rumor and buy the news situation? What do you mean by that, Brian? Walk us through it.
Sure. Yeah. Thank you so much for having me. And with Monday being Inauguration Day, it's also a holiday with MLK Day. So markets here in the United States are going to be closed. I'm really curious to see what it is that he's actually going to do within the first 100 minutes and then the first 100 hours of his administration. There's been a lot of anticipation of what he may or may not do. We see how the markets reacted to some of the releases, say the Washington Post article about watering down some of the tariffs, and now the apparently from Scott Bessent saying about maybe taking a gradual pace of hiking tariffs. The market seems to like that idea, and yet we are still struggling here. The dollar is stronger. We see yields where they are, all this volatility. I think there's a lot of angst, some anticipation that he's going to go big, and maybe he won't. Maybe it's actually going to be a little bit more measured, and that's where I think that it's been this almost sell the rumor and perhaps a buy the news kind of opportunity here, that once we get that uncertainty out of the way.
Do you think we're going to get that uncertainty out of the way that quickly, though, Brian?
I think that we'll actually have a pretty good idea about what the first, say, fiscal quarter is going to look like as far as priorities in very short order. I do anticipate that maybe he's going to take from having his hand on the Bible, doing the swearing in, to actually sitting down and signing some executive orders. It would not surprise me if that's what happens. And that would really start getting the ball rolling, and I think bring some clarity as to how quickly and of what magnitude will we see in terms of tariffs, immigration policy, and then priorities when it comes to deregulation.
Brian, we had another strategist on the show today, smart guy like yourself, and he was telling us he doesn't think investors might be paying enough attention, Brian, to the real possibility that the Fed could actually raise rates in 2025, the real possibility that we see a reacceleration in inflationary pressures thanks to different variables, including fiscal policy coming at us. What do you make of that, Brian? Do you agree with that?
I disagree with it. I mean, I can understand it, and I do think that for a while that it did look like the Fed was really having the blinders on to be on this course for cutting rates. And then all of a sudden, after the last meeting, it raised the possibility as maybe they actually want to hike, because if all of a sudden they're starting thinking about how immigration reform, tariffs could create some temporary inflation, what's their reaction function to that? Might they actually want to hike? Because we do know in 2018 that they decided to look through tariffs and any possible inflation effect there and actually provide accommodation that is cutting. This time it seems like they want to actually do the exact opposite, where because growth is so strong that they might actually want to start hiking if there are inflationary effects from tariffs. I do believe, though, that is a minority view on the Fed. So I can understand why some people might still be kind of worried about that. But in my mind, Christopher Waller today really laid some of those worries aside. And it's almost as though, you know what, at worst, we're just going to take a longer pause as opposed to thinking about hiking.
And Brian, what does all of this imply for the momentum trade that we referred to at the beginning? Because the momentum trade really worked for pretty much all of 2024 here. We've seen a loss of momentum here, not just to begin the year, but kind of since mid-December. What are the signs that that may be coming back?
Sure. Yeah. So momentum, as far as a factor, right, just the idea that strength begets strength, that really began to fade back in the middle of December. And so it's struggled here. And I think you actually see it in today's action, why the NASDAQ is down and yet equally weighted S&P is actually positive. The reason why I think that could be coming back is whenever we see real yields on the 10-year Treasury begin to move lower, like they have recently, that tends to be actually good for the momentum trade to get a bit of its mojo back, so to speak. And so even though I would love it if we saw almost a widening of participation in the gains, the breadth improving, we could go back to the playbook about, well, once again, it's somewhat a narrow market driven by momentum. Not that others are going to do badly, just relatively speaking. I think that perhaps with real yields coming down, that could actually sort of rekindle that momentum trade.
We'll be watching it. Brian, thanks so much.
Thank you.
Tech executives are gearing up for the return of Donald Trump to the White House. Many of them have warmed up to President-elect Trump following his election victory, and several prominent CEOs are expected to attend the inauguration to mark the new Trump era. But what do these leadership ties mean for investors? Evercore ISI Senior Managing Director and Head of Internet Research, Mark Mahaney, joined us now to discuss. Mark, reportedly, Elon Musk, obviously, is going to be at the inauguration, but also Jeff Bezos, Mark Zuckerberg, Tim Cook, Sundar Pichai. So, kind of a who's who of tech CEOs. If investors are watching this, rapprochement between the tech world and Trump, what can they expect it to mean concretely for these companies, if anything?
I'm not sure, Julie, is the honest answer. I think it's probably an outlier, though. I think if you go back to the last couple of inaugurations, I can't recall the major tech CEOs going to any of those inaugurations, but maybe I missed it. So
they certainly weren't sitting up on the dais, I don't think, Mark.
No, okay. So it makes it unusual. And I guess if you're an investor in one of these tech companies, it's probably a positive sign. Look, the backdrop here is that there have been concerns that Trump President Trump would be anti-big tech. I think he called Meta the enemy of the people. So the extent that the executives are shown there as having cordial relations with the president, I think that's probably a good thing. At least it maybe offsets some of the fears that that there could be some, I don't know, some negative actions taken against some of the big tech companies. I guess that's my only real read into it. I don't think, frankly, for most investors, I don't really think it matters. They're going to focus on things like interest rates. They're going to focus things on, most importantly, on the fundamentals of the company. And can they continue with the growth rates that they showed in the back half of last year? Right now, tech is sitting pretty well. We're close to all-time multiples. We're at high, for each of these companies, especially the ones I look at, like Amazon and Google, on Meta, they're at relatively high multiples, strictly Meta and Amazon. In order to keep those multiples going, you need to have the fundamentals keep going. I think that's going to happen, but there is risk here.
Mark, another trend I want to get your take on, quantum computing stocks. You don't cover that sector, I know that, Mark, but some of the names you do cover have weighed in there. Meta, Mark Zuckerberg had thoughts. I think you could argue, part of what jumpstarted a lot of excitement in the space was, Google's Willow chip. I'm just curious, Mark, as a financial analyst, how you're thinking about that, if you're thinking about it. Are you getting questions from clients about that?
Yeah, I'll put it in a broad backdrop. We're still working through this backdrop of Gen AI. I think this is not something that lasts for a quarter or two. This is a couple of year, 5 to 10 year transition, kind of, or technology replatforming, or kind of a benefit for the tech sector. Really, very much like the rollout of mobile or the rollout of broadband has been over the last 10 and then 25 years ago. And I think these are things that can really help these companies, fundamentally. How does it show up? I'll tell you how it shows up. You get much greater efficiencies in their workflows. When Google tells you that 25% of its code is being written by AI, that probably tells you that Google can continue to grow, sustain top-level growth rates without the kind of headcount surge that they've needed in the past. When Amazon tells you that its most advanced distribution centers are going to have a 25% lower cost to serve than other distribution centers, that tells you that they can probably sustain growth levels without having to invest and grow the headcount, the capital expenditures as aggressively as they had to in the past. So that's on the cost side, and I think there's a lot of benefits on the product side too. So I'm more interested in following that chain right now, because I think it's material to these businesses. I think it was in 24. I think it will be again in 25.
Well, and when you look at these three companies that are in your coverage, the three biggies, right? Alphabet, Amazon, and Meta, what's going to be the biggest obstacle for them this year to continue to expand at the rate that they have been?
Well, barring new regulatory changes, and I do think the one that's most in the crosshairs here is Google, which has been found to be a monopolist and is undergoing a remedies trial for that. So that could well be the biggest obstacle. That we're going to probably get a resolution of that by August, but though it's very possible that drags on. We'll get a judge's decision on remedies. It's possible that process drags on for multiple years, but it's also, I think the odds have increased materially over the last 6 months that we actually get some sort of settlement between now and then. So, but that's kind of the big wild card. Other than that, you've got currency, which is, the dollar strengthened something like 9% since the beginning of October. And all of these are multinationals, which means that roughly half of their revenue comes from overseas, which means that it translates at much lower levels than people would have assumed a few months ago. That's going to cause reported growth rates to look slower than maybe investors had sort of thought. You have to work through that as an investor to figure out how much of this is currency and how much is this the core business slowing down. I don't see any evidence that the core businesses are slowing down, but FX headwinds will create a little bit of a wind. I'd watch for that too. And then finally, just valuations. I mean, look, we've had a phenomenal 2.5-year bull market for equities, but particularly for the large cap, high quality growth names. I mean, they've more than doubled off their bottoms in the middle of 2022. So, that only can continue for so much longer. But I do think we have a benign macro environment that can help these stocks continue to at least compound, not re-rate in the way that they have the last 2.5 years, but at least compound.
And Mark, you mentioned regulation. So I guess I'll kind of circle back to my first question, which is, do you think that there will be a meaningfully different regulatory approach towards big tech specifically from this administration?
I think so. I think the single biggest change, I may be wrong on this, but I think the single biggest change is going to be on antitrust. And I'm sure the Trump administration will be assertive on antitrust. But we had with the Biden administration kind of a generationally different approach to antitrust. I'm not making a value statement right or wrong. We just did. And we had a much more aggressive and a kind of a neo-Brandeisian, I think that was the terminology, approach that the head of the FTC and the head of the DOJ's antitrust group had towards big tech. I don't think you're going to have that in a Trump administration. I don't know if you'll have that in future administrations. There was a change in thought on it, and now we're shifting back. So I think at the margin, that means that antitrust won't be as enforced as aggressively as it was in the past. I think you're going to get more M&A, and I think that's probably good for investors, and it's probably good for these companies.
Mark, always great to see you and have you on the show. Thank you.
Thanks, Josh.
Well, on this week's episode of the Yahoo Finance podcast, Warrior Money, hosts Patrick Murphy and Dan Coons are joined by Secor Asset Management advisor Andrew Bang to discuss the overlooked scaling issue that the Department of Defense faces. You can scan the QR code below to stay up to date on the latest episodes, and be sure to watch Warrior every Friday at 12:30 p.m. Eastern. Here's a look at this week's episode.
As entrepreneurs, we've invested, our partners and I, and us, about $75 million in 62 veteran-owned companies. But a lot of these small businesses, especially emerging tech companies, they die in the valley of death, right? They can't get there because the government sales cycle is so long. What gives you promise, and what do you forecast moving forward in the future with these public-private partnerships?
Yeah, I think couple things. There's already public various programs existing. Public-private partnerships, I think most of the listeners and viewers may have heard of, whether it's the In-Q-Tels of the world, right? DARPAs of the world, where from an R&D standpoint, these organizations invest in emerging technology, emerging innovation. And each of the services have internal R&D. But from a scaling standpoint, but from a larger standpoint, I think my understanding is that there needs to be additional partnership, more partnership, and also from a investment, the finance piece of it, there are some tremendous opportunities from a return perspective, whether it's the public-private, whether it's investing in public securities, as well as from a private sector investment in private alternatives, whether it's private equity, private credit, real estate, where some of these perhaps infrastructure, government projects partnering together may allow for increased access as well as investment from a risk return perspective, which I think is important from a finance and investment standpoint to explore and continue to explore.
On Monday, Elon Musk, along with several other big tech executives, will attend the inauguration of Donald Trump. While Musk has become something of a right-hand man, a first buddy, as he's called himself for the president-elect, the others will be attempting to curry favor with the soon-to-be 47th president of the United States. Joining us now, Mark Penn, Stagwell CEO. And Mark, thank you for joining us. I know you recently had the opportunity to talk to Elon Musk, but I'm curious first to look ahead to Monday and sort of how you would characterize this inauguration, especially with that corporate presence versus what we have seen in the past.
Inaugurations have always had, this kind of presence. So have conventions. Look, I think it's super interesting that Elon Musk has really, agreed to participate in a serious way in the administration, and that the other kind of major tech executives are coming out. I mean, look, the financial innovation of the country is driven in large part by these companies and these incredible executives of these companies. So it is a good sign, I think, that they're coming out for this inauguration.
How do you see the relationship sort of between Trump and big tech kind of evolving, Mark? Because it's interesting. Sometimes Trump talks about, big American tech companies. He sounds like a potential ally. Other times, not so much, Mark. I'm just curious, how do you see it evolving over the next few years? Do you think these American tech CEOs, whether it's Zuckerberg, Bezos, Musk, can they have an impact there in terms of the relationship, in terms of how he sees these multinationals?
Well, I worked with over the years and advised a lot of the tech companies. And the more they stuck to their business, the more politics stayed away from them. And the more that they got involved with politics, the more it became rather phony. So I think we've gone through a period here where a lot of the social media companies, and I think Elon Musk stood up and blew the whistle. And you've seen now Zuckerberg say, you know what, you're right. We've seen a period here where there was an intersection between speech, politics, and the tech companies. And I think to the extent that the tech companies dissemble that connection, get back to more open platforms, not kind of involved in government-related censorship, I think the relationship is going to be stronger than it was.
Well, but Mark, by the same token, certainly Trump in the first administration, targeted companies, and even when he was out of government, talked about companies negatively within tech that did what you're describing. But he also targeted other companies, right? One of his criticisms was of Amazon, which I think was unfounded, that he talked about that they took advantage of the U.S. Postal Service with their shipping. He talked about Air Force One being too expensive for Boeing, right? He talked about the business practices of some companies. So how much do you think that what we're seeing occur right now is defensive?
I don't know if it's defensive or not. I do think that I do think that Trump will continue to point out those instances in which he thinks big corporations are getting unfair subsidies, right, or getting a break or something like that. I think that's in his nature. And that's not going to change. But remember, the main thrust of his industrial policy is overseas manufacturing breaks. And his main thrust in that really relates to China. So you may see items like, well, I think Air Force One is too expensive. But in the scheme of things, his big policy moves involve trade, tariff, and China. And that's really where the big policy pieces are going to move.
I'm curious, Mark, you did just speak and interview Elon Musk. Just kind of a thought experiment, Mark, for you. What if the Democrats had really embraced Musk, right, rather than kind of doing everything they could to distance themselves from him? I mean, you remember, a White House, they hold an EV summit, they snub Tesla at it. Do you think that was possible? Do you think that could have had any kind of meaningful impact on the campaign, on the election?
Well, of course, of course, RFK Jr. started out as a Democrat. Tulsi Gabbard, she started as a Democrat too. And look, I don't think it would have. The Democrats put huge subsidies into EVs. I think Elon's issues were not really about that. They were about how's government operating, how is government innovating, how efficient is it, and is speech really being quelled with the help of government? I think that's a big, sincere issue. I think that his purchase of X was as much about putting a flag down on free speech as anything else, and a belief that a free speech platform would be a better platform. And for whatever reason, Democrats departed from what is the core value of most Americans and backed government censorship, which is not something the Democrat Party ever stood for in a million years.
What do we, how do you think about, and how does Musk think about himself as sort of a government representative effectively at this point, right? There are reports about him having diplomatic back channel conversations, for example. Is that an appropriate role for him to be playing?
Well, I can't speak for Musk, and I don't know what the reports are, whether they're accurate or not. I can say that I asked him about, both the technology and innovation and about his role in Doge, and I think that he is trying to play a sincere role in trying to find government cuts and government efficiencies in the order of, he said, $2 trillion would be, at kind of an outer edge. The trillion would be realistic, and that will make a very big difference for the economy if he delves into that goal.
Mark, good to see you. Good to have you on the show. Thank you.
Thank you.
Time now for What to Watch Friday, January 17th, sponsored by Tasty Trade. Starting off on a housing front, housing starts and building permits data for December coming out in the morning. Economists forecasting housing starts to tick up to 1.33 million, while building permits drop to 1.46 million. New data giving us more insight into residential construction amid a sluggish housing market.
Moving over to earnings, we'll be getting reports of names like Truist, Schlumberger, and State Street. Truist continuing a string of bank earnings we've seen to start the season. The bank will announce fourth quarter results before the opening bell. Banks have beat estimates so far, but analysts expecting to see a pullback from Truist, with lending declines leading to a weaker top line.
And finally, we're going to be keeping an eye out for any updates on the potential ban of TikTok. The deadline for parent company ByteDance to make a sale is Sunday, or it faces having the social media app shutter in the United States. According to Reuters, Trump administration is considering a 90-day extension for TikTok divestiture if it can illustrate that there's been significant progress made on a potential sale.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Ask for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Ask You for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. As Wall Street paid close attention to Treasury Secretary nominee Scott Bessent's confirmation hearing, markets ended the day slightly lower. The Nasdaq seeing the biggest loss at just under 1%. We're going to dive into the rest of today's market trends. Then home builder optimism growing, but headwinds we know still facing the housing industry. We're going to dive into the new confidence report and what it means for the sector in 2025. Plus, how about them Cowboys? America's team could soon make its most audacious head coaching hire ever and bring primetime back to Dallas. We'll explore what it would take to lure Deion Sanders away from Colorado. Well, new home builder confidence data for January rising to 47, higher than December's mark, but mortgage rates also rising again for the fifth straight week. The 30-year eclipsing 7% for the first time since May. For more, we're going to bring in Jim Tobin, CEO for the National Association of Home Builders. Jim, let's start with that 30-year fix. Mortgage News Daily here telling me we're sitting at 707, Jim. That just sounds suffocating for the American housing market. Walk me through it, Jim. What are you seeing and hearing on the ground?
Yeah, that's been our worst fear, is that mortgage rates go up rather than down. As you said, since the summer, this is the first time we've hit that 7 handle. It's gonna keep the market cool. It's certainly going to keep that existing housing market bottled up, and it's going to keep buyers that were looking forward to the spring housing season on the sideline a little bit longer until we get a little bit more certainty with the incoming Trump administration. You have economists there in-house, Jim. When they try to figure out, estimate, model where the 30-year fix goes from here, what are they saying? It's going to be bumpy. And we had really hoped by the time we had finished 2025 that we were down in the really close to that 6. Starting to think about the high 5s. We pushed that forecast off into 2026 now. So we've had to revise our forecast and again we're going to see higher rates for longer, given the current environment. But we think again they will trend down through the course of this year, just not as fast and as far as we thought. So that's the affordability side of the equation, Jim. What about inventory? Talk to me about the trends you're seeing. Well, we are seeing new housing inventory is up again. The mortgage rates are keeping people from moving in, but we're still seeing very low inventory rates in the existing market, which when you couple those together, we still have a very tight housing market out there where the supply, the monthly supply is still in that 5 to 5.5 month supply. So again, still a tight market by all accounts. Again, and rates are suppressing demand. Jim, we talked about this when Trump was on the campaign trail. Listen, housing was an issue, and the Trump team talked about it. Are there levers he can be pulling here to increase supply? Sure. I think first and foremost, the regulatory environment. We're really anticipate over the next 4 years that we're going to see a relaxation in some of the more burdensome federal regulatory environments that really drive up the cost of housing. I think the other piece we're going to see about financing, right? We have a tax bill coming from the administration and Congress in the first part of this year. That's going to give people confidence in the economy. And then, of course, we've got to talk about Fannie and Freddie and whether or not we're going to see Fannie Mae and Freddie Mac released back into private hands. That's something that we're going to be engaged in. So there's a lot of things the president can do here to bring more supply into the marketplace. And finally, really just the rhetoric of talking about building more housing as a way to get out of the housing affordability crisis we're in and driving that message to local governments who really control the levers of land in this country. Jim, Scott Bessent, Trump's pick to run Treasury before the Senate today, making it very clear he supports tariffs. How is your industry thinking about that potential policy? Wait and see. I think anytime tariffs are going to be passed on to the customer at the end of the day. We view them as a tax, unless, of course, the tariffs work in the opposite direction, which is to make sure that we are using that protectionism to increased production of needed building materials here in this country, I'm all for it. But it's a wait and see. We will see how the tariffs get implemented, whether by the executive power the president has or what Congress does. But it's very much a wait and see, and what products actually get tariffed here.
And finally, Jim, just curious, what are you hearing from folks on the ground in Southern California and those devastating fires? What are home builders telling you?
It's a terrible situation. The fires are barely controlled, if at all. Over 12,000 structures have been impacted. It's very difficult right now. Tens of thousands, if not millions, of people displaced, and a long road ahead for rebuilding that area. Governor Newsom has relaxed some of the environmental and regulations that will impede development and reconstruction out there. But we are still talking 5 years before we're going to see the vast majority of those people back in their homes. You got insurance claim issues. You've got a toxic environment that needs to be cleaned up. Southern California is in for a long haul, but the nation's home builders will be there for them to help rebuild those communities.
Jim, always good to see you. Appreciate your time and insight.
Thank you.
The major indexes struggled to build on the previous day's surge, closing the day lower as tech stocks slide. Here with the trading day takeaways, Yahoo Finance's Josh Schaefer. Josh.
Hey, Josh. Yeah, so a couple key data points out today, and then also some commentary from some Federal Reserve officials. So I want to start there. Federal Reserve Governor Christopher Waller talking today, Josh, about the fact that he sees a path for interest rate cuts in the first half of 2025. He talked a lot about the disinflation path that we started to see in that data yesterday. And Waller sort of arguing that essentially if we continue on that path for several months, you could still get a rate cut this year. So we did see that play out a little bit in the bond market. We're looking at the 10-year T-note here. Move lower today, move down about 5 basis points. What I think is interesting to point out, Josh, we've been talking so much about rates up, bad for stocks, right? That's been sort of the trade, so to speak, over the last month. Well, just because rates come down a little bit doesn't mean that you automatically get stocks up, right? So stocks up over the last 2 days. You look at today, it was kind of just choppy trading action. There wasn't a lot going on. I think part of that probably does have to do with, again, when we pull up this 2-day, this was the best day for the S&P 500 since the election. So to come off a day like that, it seemed like perhaps maybe just a little bit of a breather after a pretty aggressive rally we saw yesterday.
Yeah, it was interesting. We did have a strategist on the show today, Josh. We were talking about the Fed, and his point was he actually thinks investors aren't paying enough attention to the very real possibility, in his opinion, you still see a Fed raise rates this year.
Yeah,
he continues to think, listen, the prospect of a reacceleration in inflationary pressures is real.
We're in a moment right now, Josh, where we're definitely overreacting to every data point, which we often do, but it feels perhaps maybe even a little bit more extreme. One other way I'll show you this, I'm going to go back to that 10-year T-note. And if you look at the market action over the last 5 days in this, it's very extreme. Let's see if we go out 9 days. There you go. You had this big jump higher off the jobs report, right? Then you get your soft inflation print. Big jump lower, you're almost barely unchanged over that period. So it's just been very jittery right now. And I don't think there is a clear read on exactly where we're headed. And as the Fed likes to say, and sometimes I do agree with that opinion, we might need a little bit more of the totality of the data, Josh, to get a better sense of what's going on. But I want to move to one other data point. Retail sales today, and really I think the broad takeaway from retail sales, so the headline number came in a little bit below expectations. But when you look at the control sales group, this is what feeds into GDP. That rose 0.7%, higher than the 0.4% expected. Here's what that translates into for a GDP projection. So you moved up a little bit right here. This is the Atlanta Fed's GDP Now model. They take all of this data that comes in throughout the quarter, extrapolate that out into an economic growth story for us. GDP now at 3%, up from 2.7%. So the overall story here being we likely ended 2024 with the U.S. economy growing at a pretty solid clip.
Yeah, and economists, on the show today, we were talking about this, Josh, they were going to point out that, listen, high income still spending, right? And even they said low, middle income. I mean, yes, a range of challenges we've talked a lot about, but thanks to a labor market that's still resilient, Right. They keep spending too.
And this continues to be something, Josh, too, when you combine that economist story and the strategist story we were talking about earlier with the Fed rate cuts, right? This still seems to be one of the things people keep telling us, right? You want GDP above this 2% number if the Fed isn't going to cut this year to still be in a good situation for the stock market. So I think this is overall a positive if you're an investor in the equity market right now, that the U.S. economy continues to be growing at a solid pace and will be something to watch as the year goes forward.
All right, Joshua, thank you. Appreciate it. Stick around. Much more Ask for a Trend right on the other side. How about them Cowboys? America's team could soon make its most audacious head coaching hire ever if Deion Sanders decides to leave the University of Colorado and return to the NFL franchise where he became a household name. Joining us now to discuss, Joe Pompliano, Yahoo Finance Sports Report host. Joe, it is good to see you. So let's start right there, Joe. Do you think Jerry Jones does hire Deion Sanders as next coach of the Cowboys? I would love to see it, Joe, just for the drama, the headline, the stories, but it's hard for me to see it, Joe, because Jerry is a big brand. Jerry likes being a big brand. If you're a head coach, you know you are Jerry's employee. Deion's a big brand. I don't know if Deion wants to share that spotlight, but give me your take. What do you think?
Yeah, I think you nailed it. I mean, those two guys might have the most conflicting personalities that we've ever seen in sports if that was to happen, right? But Jerry knows better than anyone that sports is all about entertainment. If you think about the Cowboys, they're the most valuable franchise in all of sports. So the only organization ever to cross $1 billion in annual revenue, and they've done it 3 consecutive years, right? So he knows that attention is super important, especially when you don't win a Super Bowl in 30 years. And I think that's why he's considering Deion Sanders. If you think about the timing of these leaks, they happen during NFL playoff games when the Cowboys are not in the playoffs, right? I think that tells you all you need to know, that Jerry knows that entertainment is first and foremost the reason that the Cowboys are so valuable over the years. And Deion would bring a lot of entertainment to the team. Now, for Deion's perspective, I'm sure he would love to be the coach of the Cowboys. If you think about his college resume, he had a great year at Colorado this year, all things considered, but he's essentially a 500 coach. He's 13-12 at Colorado over the last 2 years, despite having a top 5 pick with his son as the quarterback and also a Heisman Trophy winner. So we'll see what happens, but something's telling me that their personalities would clash a little too much for Jerry's liking.
There's some, Joe, listen, I'm not a Cowboys fan, but you will hear this argument, just get your take, that people will say, listen, a strong, competitive, successful Cowboys team is just bottom line good for the NFL. It's good for the league. What do you make of that? You buy that?
I would agree for sure. If you think about Jerry Jones, he sort of revolutionized how the NFL business model works. Many people don't know this, but Jerry Jones actually got sued by the NFL in the 1990s. What he did when he took over the team was he went out and he signed these sponsorship deals with the stadium rather than the team themselves. And the reason why he did that was because the revenue sharing agreements between the league were for national sponsorship deals. So the league sued him, said, hey, this is basically going around our agreement. He countersued them, and it changed the business model because they settled out of court. And now these teams are allowed to keep local revenue, right? So he has a $20 million deal with AT&T for the stadium in Texas. He has a $20 million deal with Molson Coors to sell beer inside the stadium. And that's all revenue they get to keep, where they're now doing $800 million a year in annual revenue at the team level, whereas no other NFL team is doing $400 million. So the Cowboys are by far and away the biggest brand in the NFL. And yeah, I would argue that it's great for the NFL when they're good.
Joe, another big topic, UFC. Reportedly, Joe, looking for $1 billion a year for its next media rights deal. Its deal with ESPN ends in 2025. Walk me through how this is going to unfold as you see it.
Yeah, I think the UFC media rights deal is the biggest storyline of 2025 in sports business. And the reason I think that is because they're probably going to get $1 billion a year in their next deal. I think that the UFC is probably going to move from a one network model with ESPN today to a multi-network model like you would see in the NFL or NBA, spreading their rights to a couple different players. My guess right now is that it's going to end up staying with Netflix or with ESPN for the vast majority of the rights, and then someone like Netflix or potentially even Amazon or YouTube getting a share of the other stuff. Now, it makes a lot of sense for ESPN because there's not a lot of premium sports rights up for grabs over the next few years with the NFL, NBA all figured out. So they want to keep that product while they launch their new streaming service. And then if you think about Netflix, I particularly think it makes a lot of sense for them because they've started to roll out this premium live event strategy, right? They already have a deal in place with WWE's Monday Night Raw that's for $5 billion. That company is owned by the same parent company as the UFC with TKO Group. And I think Netflix is going to be able to put on 1, 2, 3, 4, maybe even 5 events a year that are really premium offerings.
Finally, Joe, a quick question on the college football playoff national championship. Good news in terms of the money. Let's follow the money on this, Joe. Good news for Notre Dame. But you also argue, I thought this was interesting, you point out the pay structure is evolving here. It's about to change.
Yeah, so if you think about the pay structure today, the college football playoff awards teams for making it into the playoff and then advancing. So every team gets $4 million that makes it in. You get $4 million for advancing to the quarterfinals, $6 million for the semifinals, and $6 million for the finals. Now, a team like Ohio State that racked up $20 million, the unfortunate part is they have to share all of that money with other teams in their conference, many of which didn't make the playoff. Whereas Notre Dame, since they're not in a conference and they're independent, they get to keep every dollar of that for themselves. Now, the unique part here is that that structure is going to be changing in the coming years when their new deal with ESPN kicks in 2026, where you're only going to get paid a flat fee each year for the tournament, whether you make it or not. So every SEC Big Ten school is going to get $21 million a year, regardless of if they make the tournament or not. Notre Dame is going to get 12. Notre Dame can still increase that to 18 based on a one-time performance bonus for making the tournament, but they're not going to get the financial advantage that they're getting today.
Joe, always good to see you and have you on the show. And be sure to scan the QR code below so you can stay up to date with the latest episodes of the Yahoo Finance Sports Report, dropping every Thursday at 5 p.m. Eastern. Here's a look at today's episode, breaking down the NBA's new media rights deal with Amazon, featuring another member of the Yahoo family, Vince Goodwill.
When you look at Amazon going to the NFL, and as much as people were addicted to the NFL and how easily you can picture going to Amazon now, whether it is through your streaming situation or whatever, the first year or so, it seemed like it was a little bit on the rough side. People were complaining. They were wondering if Amazon had the bandwidth to actually hold it. But it happened over the course of a year where they wound up getting better games and people got used to, oh, Thursday at 8:15, we have a game on Amazon. With the NBA, going back to NBC is a little bit different because there's a sense of nostalgia there. The NBA on NBC was part of the league exploding in the 90s with Michael Jordan and the Dream Team and some of the transcendent stars of that period, some of the new age stars of that period. The NBA moving to Amazon is going to be a little different, but I think that's why the NBA did not mind the NFL going there as a trial.
Well, for our chart of the day, we're taking a closer look at inflation during different economic eras. And Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Yeah, this coming to us from Liz Ann Saunders of Schwab, a really interesting analysis and way of thinking about markets and the economy now versus what it looked like for the last couple of decades. So what we have here is the year-over-year change in inflation. And this looks at sort of the 60s through the 90s when there was a pretty much higher inflation regime than the lower inflation regime that we saw through the mid-90s through really the last several years before the current spike in inflation. Liz Ann was on Yahoo Finance this morning, and she talked about the relationship between inflation at these times and the markets. Listen to what she said.
For almost the entirety of the Great Moderation era, bond yields and stock prices were positively correlated, because when yields were moving up in that era, it wasn't because inflation was igniting, it was because of stronger growth. very different than the period from the mid-60s to the mid-90s. When yields were going up in that era, it was often because inflation had reignited, negative for the equity market.
So she posits that perhaps we're getting back into, or have already gotten back into, that kind of an era. And this would explain the recent action that we've been seeing, right? Where you have higher bond yields that, while they could be read as a sign of a stronger economy, are also raising concerns about what they reflect in terms of the outlook for inflation. And what we have seen, once again, is that negative correlation. In other words, when bond yields go up, stocks go down, and vice versa. We saw it today to some extent, although there was a little bit of wobbling in the equity market. So the yields coming down were not just an unmitigated positive for stocks. But over the longer term, is this something we're going to see in a higher inflation regime? Perhaps, if this historical comparison does prove to be true going forward. We'll have to watch it, Josh.
We will. Thank you, Julie. And that is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.